Greetings, friends, and welcome to the Financial Game. As always, Jose Miguel Crespi is here with me, and today we have a feast of data and analysis for you during these times that are usually a bit, unstable from the perspective of uncertainty and geopolitical situations. Jose Miguel, welcome.
Marian, thank you. I'm happy once again to be recording an episode of the Financial Game with you. And yes, we are certainly living through interesting times for those of us who are in the financial world, in the world of investment, capital, and risk. So basically, yes, we're recording here while there's essentially a war going on in the Middle East involving Iran, the United States, and Iran, which is now, of course, widely known. Markets started the year extremely volatile, in fact, negative.
We had anticipated that, by the way.
Correct.
On the record. We had said that we were going to have, in fact, by the month of March, without knowing about these kinds of circumstances, we had mentioned that based on the analyses we had seen from Larry Williams and the cycle analyses, it seemed that this year at some point we were possibly going to have a moment of volatility, instability, and we had projected May, April around that time.
March. All these currents are converging at one point, and on top of that, the situation with oil, obviously, with Iran being one of the main oil exporters. This barrel of crude that at one point reached 120, today it's at 105. This, of course, has created instability in gasoline prices. They've gone up. If we look, as they say, at the pump, the price per gallon here in the United States or per liter in Puerto Rico, we've obviously seen a pretty substantial increase, more so in diesel than in gasoline. I have friends and contractors who work with us, and the vast majority of them have diesel trucks, and they're struggling here. At least here in South Florida, Southeast Florida, we're seeing a diesel at $5.75 to $6 per gallon. In California, on the west coast of the United States, it's even worse, much worse. It's the same with gasoline. I think on average, we're paying almost $4 per gallon now.
Almost, yes.
$4 per gallon, so definitely a lot of instability, Ferdinand, to start things off. Thank you, right? 1 plus 1 is 2, as they say. This is going to increase inflation. Tell me a little bit about the economy. How are you seeing things? Combine it a bit with some history for our audience. Earlier moments, I know you have a lot of information to share, so I'll give you the floor. How are you viewing the situation?
Well, first, in plain terms, as we say, why is oil a factor? Let's start with the first question. Well, look, this jacket I'm wearing is made from petroleum derivatives. This shirt I'm wearing is made from petroleum derivatives. The shoes we're wearing and the soles are made from petroleum derivatives. Almost everything has a derivative, and that trickles down to the consumer. For example, I was talking with Eli. When you go and fill up a gallon, well, you used to fill it up before for 50, 45, depending on the vehicle, right? Well, now I want to tell you that it won't cost you less than $100, so subtract 60 from your budget. Those 60 were maybe for entertainment, shopping, spending, going to the movies, going to a restaurant, having a beer, or going to a happy hour. Well, now that money stops being spent on those things and goes to the gas pump. If you have that kind of situation, it has certain effects on the gross product and on production. That's also correct. That is going to cause a general increase in inflation. In other words, that's going to trickle down into everything related to consumption. And if there's inflation, that increases the cost. And if the cost goes up, it means your budget will shrink in terms of what you have available to spend.
Correct.
That's really the effect on the economy. There is an important figure that people should keep in mind, and that's why there's this current debate among economists. Some say, well, I think the probability of a recession now is 30 or 40%, Goldman Sachs, etc. Different various reports, cross currents. On the other hand, for every $10 that the price per barrel goes up, it represents 1/10 of 1% less in GDP. If GDP, which is the gross domestic product, the latest forecast I saw, is between 3.7 and 1%. In other words, we're not talking about robust growth. We're talking here about what we had predicted for some time now, since 2024 to 2025, that we were going to have a situation with tariffs with the imbalance that exists in terms of international trade. Weakness of the dollar, etc., the big beautiful bill at the same time. You have the forces of AI, so you have some cross currents that cause the economy to tend to balance itself out because of the tax big beautiful bill, which acts as a hedge against the tariffs that are part of the Trump administration's bet, part two, so that at least we would continue to grow. But if you now add the uncertainty of oil, which is a type of cost, then you're adding a reduction of 1/10 to 1%. If oil were to reach $200, and there are some forecasts that are talking about a 30% chance that we could get there, it's not certain yet, but 30% already puts me at a probability that's a bit more robust than the 15 or 20% it was before. So then that could mean that if you subtract that 10th from the 0.7 or the 1% of GDP, I'm looking over here because that's where I have that data written on the board, since I found it very interesting. I did a calculation at $200, and we would be looking at a possible recession, so that probability would probably increase to 60 to 65%.
So, in plain terms, a strong increase. Right now, there's about a 30% chance that oil could reach $200 per barrel, would wipe out the GDP growth we've seen so far, which is already quite low, right? I mean, it's positive but low. So, it's an important phenomenon that we need to keep an eye on, pay attention to, right? Because this is what would increase the probability, and the topic that would start coming up more often is that of an economic recession.
That's correct. Remember that based on history, there are two events. Unique events in the last 50 years. They are 1973 to 1974, the Six-Day War between Israel and the Arab countries, and the oil embargo war. At that time, the United States was not a net exporter, it was a net importer. It imported all the oil there was and was dependent on that region. That is not the case right now. But if we look at the reaction in 73 and 74 and look at history, that causes a recession. If we go to 1990, which was the famous televised war, the Persian Gulf War, broadcast by CNN, I remember it like it was yesterday. It was practically a war against Saddam Hussein in Iraq, which was expected to have, and that type of conflict. The invasion of Kuwait by Iraq created a historic disruption in terms of the price of oil. And it also caused a recession, and in fact caused George Bush Sr. to actually lose the election. Because Clinton said, it is the economy, stupid, it is the economy. The economy determines elections. And that year was an election year, unfortunately, even though Greenspan tried to throw him a lifeline to lower interest rates and help him recover. But it didn't happen in time for those elections, and he lost the election. So yes, it does have an impact, and with each of those impacts, the markets, both stock and real estate, are affected. They all feel the effects. Look at Bitcoin, the tremendous correction it has experienced. Look, in general terms, at the 10-year Treasury bond, which was about to drop below 4, but has now rebounded and is practically at 4.35, 4.3050, it's going to be quite a tug of war in less than 3 weeks. Well, what that does is make the cost of money more expensive, and that also makes affordability, which is a key issue in housing right now, more difficult. All of that trickles down, and also the fact that in manufacturing, the cost of raw materials is going to increase, and that cost gets passed on to the consumer, which then creates a chain reaction situation.
Well, look, right now in terms of rates, Ferdinand, the Fed and the Fed funds futures are, for now it's clear that we shouldn't expect either a rate cut or an increase. Right now, that's the outlook for the rest of the year. I have here data for the next 3 meetings. Basically, there's more than a 90% probability that there will be no change at all. But in the longer term, this could adjust that trend. And then we might even hear talk about a rate hike, depending on how all of this plays out, as you mentioned, and how it develops within the economic data. In terms of the markets, they definitely started off very, very volatile so far this year. The stock market is down, the Standard & Poor's is down 5 to 6% so far this year. Managed portfolios have fared a little better. The stress-free equity portfolio is down about 10%. It's already starting to undergo some significant changes. So we started to make a protective move, a rebalancing to protect assets, take profits, and also rebalance by raising a bit of cash. Now, Ferdinand, I've been asked how to approach the opportunity in this situation.
Yeah.
If we want to look at it from the opportunity side, then certainly those people who have a longer term time horizon are seeing a good opportunity to enter the market. Why? Because if we take a closer look at the US market, companies are starting to look relatively more affordable compared to their valuations. So this makes certain companies a bit more attractive, mainly in the technology sector. The tech giants have undergone a significant correction, which perhaps makes them a bit more appealing, but I repeat, this is for those who are looking to enter the market with a longer term perspective. For those who want to adjust for risk, to make some kind of adjustment to avoid risk, we start to look more at income positions. In the previous episode, we introduced what the all-weather
profile is. To talk a bit about it, what we're trying to do now is de-risk. Correct. De-risking doesn't mean getting out. We're not doing market timing. What we're doing is strategic allocation. Strategic allocation. And in strategic allocations, we have a framework, some bands, right? Bands where you expose yourself to a certain amount according to the risk profile of that client. And we have minimums so as not to take them out of the market because nobody knows what's going to happen in the market. We know that the exercise of market timing is not the way to build capital and wealth in the long term. Now then, de-risking does exist, which is to rebalance
strategically.
Maybe take some profits from certain positions that have gone up quite a bit. Some that have what's called relative strength, meaning you look at the portfolio you've been analyzing in recent weeks, which positions have held up better, which ones definitely aren't moving. And so that's strategic allocation. The other way of strategic allocation is this portfolio that I want you to mention.
Yes, it's more oriented towards income, stability, reducing volatility, reducing correlation with the overall market movements, and it exists. There are positions, there are ones based on exchange traded funds, ETFs, positions that can generate more consistent income for you and whose volatility is substantially reduced. I always emphasize the importance of diversifying a bit in the types of assets as well. Maybe look for alternatives that might not give you the aggressive growth we've seen in recent years, but can provide consistency in returns. They are very important. There are different strategies available, and definitely. For those people who might see this as a good opportunity, there's also the aspect of consistent investing or the well-known dollar cost averaging. Because if you are consistently putting certain amounts into the market, right now you are buying a bit cheaper at lower prices and so on. So in any case, there are ways to approach the market. It all depends on the strategy, what you want to achieve, and the person's time horizon. And definitely Feria will continue to keep a close watch on how the markets perform. In the next episode, we'll talk a bit about how these situations also affect real estate portfolios, and strategies. And I'll give an update on that as well because of the interest rates. Thank you. In real estate, there has also been, similar to what happened with treasury bonds, a slight uptick. And of course, we are keeping a very close eye on that. So there's no more time for now. We'd love to keep talking, but in the next episode, we can continue to see how things are evolving and give an update on how everything is moving. It's really important to keep people informed.
Well, until next time, and we'll see you in the next episode of the Financial Game Special Edition.